Hi there. Thank you for joining us today. My name is Marcia Butler. I'm the webinar director here at Advice Chaser. I want to welcome you as you're coming in the webinar room. And before we introduce our guest and get started, I need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you this educational presentation today. We have a lot of people who are joining us today, so hopefully we'll be able to get to questions that you might have. And so here's how to do that. You are muted, but we do encourage you to ask questions and use the chat box to do that. That's a feature I do have to turn on, so let me go ahead and turn that on now. The presenter will answer those queries during or after the presentation today as appropriate. If you ask a question in the chat box and we're not able to get to it, go ahead and leave your contact information as well. And if we can't get to your question during today's event, we'll make sure someone reaches out to you afterwards. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. I'd love to introduce you to our presenter today. J.R. Guerreri is a certified financial planning practitioner that utilizes a unique approach and methodology called financial life planning. Life planning connects the dots between our financial realities and the lives we long to live. This method is based on the premise that advisors should first discover a client's most essential goals in life before formulating a financial plan, so a client's finances fully support those goals. As a lifelong learner, musician, and athlete, J.R. holds a black belt in Brazilian Jiu-Jitsu, trains Muay Thai, and has been playing the guitar for over 30 years. And he actively performs and writes music in his band. So that's a little bit about you, JR, and we're excited to have so many people here. Let's go ahead and launch into mortgages.
Okay. This is it's a really important topic. Mortgages are the pathway, the way in which we finance real estate. And real estate is probably one of the most powerful financial tools you will utilize in your life. And I call it a tool because it's like a wealth building tool. And you can use the home that you live in to serve you financially, especially later on in your life. So it's really important to understand how you finance this thing. I'm a financial planner. I've been doing financial planning for many, many years and financial services. But interestingly enough, and Marcia, you don't even know this, my first 4 or 5 years out of college, I was in the mortgage business. So I know a thing or two about mortgages. Okay. So let's get started. One thing about real estate, and I've heard this scrolling through my Instagram feed, and then I just Googled it just now. 90% of millionaires in our country generated their wealth through real estate. 90%. That's pretty impressive. So yeah, really important topic. So the way in which we finance real estate is through a mortgage, and it's a loan provided by a lender, typically some sort of banking institution. Actually, interestingly enough, mortgages are either offered by banks or specific mortgage companies. Banks tend to not always specialize in the mortgage world. Mortgage companies specialize in the mortgage world, and there's a distinction between that. not one better or the other. It's just like, where is their focus, right? One company focuses primarily on mortgages and another one will do, you know, checking accounts, savings accounts, lending, credit cards and things, as well as mortgages, right? They make money on mortgages. So it's an important tool for the institutions that provide this product. With a mortgage, the house becomes collateral for the loan. So that's important. It is a loan against an asset, as opposed to a credit card, which is a loan against nothing, right? A loan against nothing, the interest rate is 20 to 25%, right? If you look at a credit card, that's what you see often. The APR is 20 to 25%. A loan, though, against the house is not 20, 25%. Right now, we're talking in the 6 to 7% range, but not too long ago, maybe 2-3 years ago, interest rates were like 2 or 3%. So it's to understand the context of how much interest you pay on something, it's important. Okay, next slide, please. Okay, so the rate. So interest rates are the additional money you give to a lender, a mortgage company, a bank. It's their profit. Okay, so it's based on a percentage of the amount of money that you borrow. Okay, they will fix that interest rate for the entire term. All right, we're going to get to terms in a second, but typically a term would be like 30 years or 15 years or 20 years. So a fixed rate mortgage means it does not adjust. You know what you pay every month for the foreseeable future, which in comparison to the next slide is adjustable. So an adjustable rate mortgage means that your payment will adjust to where the interest rates are in that moment in time. Okay, so if interest rates go down, you are being rewarded from your monthly payment perspective, right? If interest rates go up, not so fun, right? So when the interest rate goes up, your monthly payment will go up. So there is care that needs to be taken into when you use something called an adjustable rate mortgage. You will hear the word ARM quite often. It's just that's the acronym. Now, what happens is with these adjustable rate mortgages, and it's not on the slide, but what they do is they will fix the mortgage payment for a short period of time. So let me give you an example. Most people in our country utilize a 30-year mortgage, meaning that you pay back the loan in its entirety plus interest over the course of 30 years. An adjustable rate mortgage will sound something like this. For the first 5 years of your mortgage, the payment is fixed. At the end of the 5th year, it will adjust to whatever the interest rate is 5 years from now. Now, what's important about that is if you leave the house within the 5-year time frame, who cares what the interest rate is 5 years from now, right? So if you believe that you're going to be in the house for the short term, an adjustable rate mortgage may be attractive because the payment typically is less than a mortgage that is fixed for, say, 30 years, if that makes sense. Okay, move on to the next slide, please. All right, well, now we're talking about the time frame in which we live in our homes. It's called home buyer tenure. So how long am I going to live in the house? You know, like if you were going to ask me on the, walking by me on the streets of New York City and go, how long should I get my fixed interest rate for? I would just tell you do 30-year fixed, right? I mean, like if I don't know anything about you, 30-year fixed seems the right idea, right? It's safe, you know what you're getting. If you could afford it, do 30 years fixed, right? But nobody stays in their house 30 years anymore. It's like, it's really strange to live in a house for 30 years. I mean, it's like, I hear there's a new term called, this is my forever home. That's like a term I hear lately, my forever home. So yeah, if you have a forever home, 30-year fix makes a lot of sense. But like most people, don't live in the same house. I mean, I'm victim of that too. Like, I have not lived in the same place for extended periods of time. So, so there's a thing called a first-time home buyer, meaning that it's pretty simple, right? It's the first time you ever bought a house, right? So if you're a first-time home buyer, means like you're probably in a situation where you've just started making enough money to feel comfortable wanting to purchase a home, right? And so you've never done it before. And so you enter into the home ownership world, but you're not going to afford the multi-million-dollar home typically, right? You're going to start off with a $200,000, $300,000, $400,000 home. And usually it's in a situation where, you know, you're in the beginning years of making a lot of money, right? You're probably going to make more money in the future. So what happens is you typically stay in it for a shorter period of time. First-time homeowners generally will stay in a house between 3 and 5 years and then upgrade to the next home. And they upgrade because either or both, they make more money, but the house that they live in has grown in value, right? So homes appreciate over time. You could take advantage of that appreciation and use those dollars to go up yourself into a higher priced home, bigger home, that kind of thing, better area. Now, the amount of time people stay in a home varies by their age group, right? So young people tend to stay in a home very short periods of time, like 3 to 5 years, whereas people in an older age category tend to be there for much longer, right? They tend to find their forever home and stay there for a long period of time. That's important to understand how long, like, and that's the thing, like when you go and decide, like, you know, what mortgage do I get? Like, you have to say, well, how long am I going to be here? Like what's the real time frame here? Let me be realistic about it. Okay, now, so a mortgage. So the bank hands over to you the amount of money you need to give to the seller of the house, right? They hand you $350,000 of a loan. You hand that $350,000 to the seller, and now you have to pay back the mortgage, okay? Plus, you have to pay back the mortgage with interest over time, okay? So there must be a sort of process, or what I want to say is like there's a table, and a table is, well, if I paid off, you know, $10,000 this year, what has happened to the mortgage? Then I do 10,000 next year, then 10,000 next year, and 10,000 next year. Like, what's happening? This is called an amortization schedule. It's a breakdown of what's going on. So what I'm going to do right now is I'm going to switch screens, and I'm going to share my screen. I'm going to show you what an amortization schedule looks like. What they call a schedule is the typical term they use. Okay. See my screen? All right, so I have something called a loan amortization calculator. Okay, so we have a $350,000 mortgage. I mean, that's what I'm borrowing. We have an interest rate of 6.8%. Myself and Marche just was like Googling real before the meeting, like, what are the interest rates today, right? And we found 6.8. Don't hold me to it. They change every day. Okay, start year is 2023. We're going to start till this month, and now we're going to do this thing for 30 years. So the required payment for a 30-year mortgage is $2,281.74. So you would get a bill every month for $2,281.74. Okay, so if I were to start making payments, we have this table here. So we have year 1, year 2. So like the problem, so just the thing is with mortgages, you got to understand. We think about the payment in a monthly concept, right? Monthly, our monthly bill is this, but then you take it and you look at it over the course of a year, what happens? So we have year 1, year 2. Well, I start with $350. I pay this amount of money, $2,281, 12 times in a year, right? So what has happened? I have reduced the principal by $3,695. I paid $27,000 for the year. The bank collected $23,000 of interest that year. Okay, I'll say it again because you got to get this. I paid out of my pocket $27,000. The bank or mortgage company collected $23,000 of interest. I paid down the amount of money that I owe, $3,600. So I hope you watching this are going, wait a second. I paid $27,000 and I owe $346, not $350 minus 27. No, you owe them still $346,000 after you paid $27,000. Your interest payment was $23,000. Now watch what happens as I move down into the future. What is the interest doing? The amount of interest that I pay back the mortgage company is becoming less, and the amount I'm paying off of my principal is growing. And you can go all the way down to 30 years. In the last year of the $27,000 I pay, $26,000 of that money went to paying off the loan. $900 paid off the interest that I owe. The bank collected $471,000 of interest off me. You have to understand that. They more than what you paid for the home. Okay, so $821,000 is the amount of money that came out of your pocket. You have to understand this. This is not good or bad. It's just what is. All right, back to your slide, please.
And then also, just before we get back into that, I had a question about, you talked about how a lot of people don't stay in their home for 30 years.
Mhm.
So really, they're not paying that entire part of the mortgage. Maybe they've been in the home for 5 years and they're using the sale of the home to pay off the mortgage.
Right.
So they're not paying off that interest because they're not in that home for
right. So if we
30
did
years.
1, 2, 3, 4, 5 times, you're looking at over $100,000 of interest you paid over that time frame, but you didn't pay down the mortgage by $100,000. You only paid it down by, it's like 25 grand or something. So
yeah, it's good. It's good to have that information.
Mhm.
Okay, let's move on here.
There we go. Principal and interest. Principal. So you're going to hear these words, the principal. That's what you owe. Okay. Every time you make a payment, the principal is reduced by the amount of money you pay. And it's like, think of it as proportions, right? If I make a, $2,000 a month payment, that's $24,000 a year. What is the proportion of principal and what's the proportion of interest? Interest is what you owe the bank. Yeah, and it says it right there. Over time, the interest proportion decreases while the principal portion increases in the payment. Okay, next slide. Okay, so everybody wants to know, where does this stuff come from, right? And so the Fed. So the Fed is an institution that lends money to society. All right, now society gets those dollars not directly from the Fed. The Fed gives it to the banks of our society. And then the banks owe the Fed interest. In order for banks to operate, they have to make money. So on top of the interest the Fed charges the banks, okay, the banks will then charge you, it's called a spread, right? And the spread means a few percentage points above what they have to pay in the form of interest, okay? And then banks lend back and forth to each other. And so there's this world of, there's a business relationship, if you will, between the banks and the Fed, okay? And that's how interest rates are determined, right? So a lot of people are understanding over the course of a year, something very interesting happened in interest rate world. So the Fed raised interest rates. So it raised the amount of money that they are charging banks. Okay. Now, the reason why they're doing that is because everything got very expensive in society, and a way to curtail things getting very expensive and just going absolutely insane so that your eggs and your milk don't cost $20 a piece. All right. They have to curtail, they have to slow down inflation. The way you slow down inflation is you raise interest rates. I mean, we could go into this forever, but let's just keep it that simple for now. And if you want to ask me more questions later, that's fine. So that's what the interest rates are based on. But your interest rate is determined by you, meaning how attractive you are to lend money to. So a person that has, so we have a recorded history of our of the way we are as borrowers, right? And it's called your credit score, right? We have a history. So certain things that we purchase is associated with our credit. And our credit says this: if I'm late all the time with paying bills with certain kinds of accounts, it gets recorded. And the late you are, and if you don't make payments, guess what? You get a bad credit score, right? Or a low credit score, okay? And that, when you're getting a mortgage, they want to see, does this person make payments on time? If they don't, well, we're going to give you a higher interest rate. You're a riskier borrower, right? If you have a perfect credit history, meaning you pay all your bills on time, then your interest rate will be less than compared to somebody who doesn't. Next thing is so income stability just really has to do with like how well you pay your bills, right? That's what it means, right? But another way to keep your interest rate lower compared to somebody else is you put more money down on the transaction, meaning that you've all heard this concept called down payment. So when you buy a house, you're going to contribute money to the transaction, and the mortgage company is going to contribute money to the transaction, right? So the more you contribute, the more risk you take on as an individual, the bank rewards you for that by giving you a lower interest rate. Okay, so somebody who puts no money into the home and all the responsibility of the financing of the home is on the bank, guess what they're going to do? They're going to raise your interest rate because you're riskier than someone who put a lot of money into the transaction. That's how that works. Now, the debt to income ratio has to do with approval. So when you go and buy a home, you have to get approved for a mortgage. They don't just give it to anybody. They need to know what the word income stability means, is that you make enough money consistently over the last, let's say, 2 years. They look back as far as 2 years and go, well, this person has made this much money for the last 2 years. The new bill coming forward, the new payment that they have for the mortgage, okay, is low enough that it fits inside their house budget, right? And they know what your budget is because it's on your credit report. And they can see how much money you spend every month. So if your income is a certain level and this new payment plus all the other debts you have, if it's at a certain level, then they're going to approve you, right? So what are those levels? And this is just like too much information, but I'm going to tell you anyway. So generally speaking, mortgage companies, I've seen it approved as high as 50%. So half of the money that you make goes towards your home. That's a lot of money. I wouldn't do that if I were you, right? But they will do it. They will approve it. All right. Generally speaking, this is a nice rule of thumb. Don't take this as advice, but if you keep your mortgage and your credit, your debt under a 25% debt to income ratio, it's a pretty good place to be. All right. And now I will, if you guys want me to show you demonstration maybe later on how I come up with that information, I'm happy to show you. Okay. So rates. You don't just walk into the first place that you see or first bank you see and go, I'm going to take this bank. You have to go shopping. Different mortgage companies have different rates. Some are better than others, right? So you have to shop. So shopping means you're going to pick about 3. That's probably the most I would do. You don't need to do 10. That's ridiculous. All right. Just find 2 or 3 institutions. You get a referral from a friend, you speak to your financial planner, you go to the bank that you do your banking with, right? Get recommendations of people that are trustworthy, find out what their rates are, and that's how you start shopping for who's going to provide you with the mortgage. Okay, next slide. Okay, so this is the down payment concept. So I was talking about this before. Like I said, when you go purchase a house, let's say it's a $300,000 home, okay? You have to contribute money to purchase the home. The banks tend to not want you to put down 0. There were times in history where they did allow that. I'm sure there's some now that might still do it. It's not as commonplace anymore, but the more money you put down meaning out of your pocket. The less your payment's going to be, typically the lower your interest rate is going to be. Okay, the more money you give to the transaction. Okay, now, generally speaking, the most common thing you will hear is that a person puts down 20% of the purchase price, right? So on a $300,000 purchase, 20% of that is $60,000. So you write a check to the seller for $60,000. The remaining $240,000 are going to come from the mortgage company. All right. Now, when you put down 20%, okay, the bank and the government are happy, right? They feel that you contributed a good amount of money and they say, here you go, here's your mortgage. They do allow you to not put down 20%. So anything less than 20% down, doesn't matter the purchase price. It could be $1 million, it could be, $300,000, doesn't matter. If you put down less than 20%, you are faced with something called private mortgage insurance. Private mortgage insurance is an insurance policy that doesn't insure you, okay? It insures the bank that's providing the mortgage money if you don't make your payments and just go into like what we call foreclosure. Okay, so they get, it's like an insurance policy. So if you don't put down, you're paying for this insurance policy that gets paid out to the financial institutions. Okay, it's a monthly cost, right? All that means private mortgage insurance, PMI, is a cost. So if I put to 20% down and my payment now is $2,000 a month, and then if I didn't put 20% down, the payment would be like $2,200 a month. So you're just paying a couple extra $100 a month more for this insurance policy to protect the banks, not you. You pay for it though, if you don't put down 20%. Okay, now the PMI can be removed later on down the road. So that extra dollars you're paying for the insurance policy can be removed. It's complicated, but it can be done. Okay, moving on to the next slide. If you want to ask me questions about PMI later on, I'm happy to answer them.
Just a comment that from what I know, it's not certain mortgage types of mortgages don't allow you to get rid of PMI, but a lot of them do. So
yeah, that's correct. Right.
Yeah, you have to ask.
Yeah, well, you have to get approved for it, right? So it's a process. That's what I meant by it's complicated. Sure. Okay, so the loan terms, typically people enter into 15-year mortgages, 20-year mortgages, or 30-year mortgages. The shorter the term, the amount of time to pay back, which means typically you're going to pay a higher monthly payment. But because you're going to pay it back faster, the bank is happy. Therefore, they're going to lower the interest rate you pay them. That's how it works. And I think we kind of went over amortization. Yep, we went over that. Okay, escrow account. So this is important. So when I go and buy a home, what's also comes along with the home is something called property taxes. Okay, so there, I believe that there's property taxes in every state in our country. Okay, different states have different property tax rates though. Right. So that's important. So property tax is money that gets paid to the state and they hopefully do wonderful things with it. What happens is you will pay your property tax through your mortgage if you choose to do so. Okay. So it's a convenience feature that, let's just say your monthly payment for your mortgage is $2,000, but you owe $500 a month for your property tax, right? So your payment now is $2,500 a month, but your taxes are handled for you. You don't have to do it. You don't have to do this, but you can do it. Same thing with homeowners insurance, okay? Homeowners insurance is the insurance policy that if your house burns down or something goes wrong, you have money available to rebuild it, okay? Now, you will also make this payment through your mortgage. Okay, now the payments towards insurance and taxes are kept in something called an escrow account. All right, so you'll see every month you're making a payment and your escrow account gets bigger and bigger and bigger. And then typically, let's say your property tax is paid every quarter. So after 3 months, the mortgage company will take the money out of your escrow account and send it to the town for your property tax. That's what happens. Like it says, the lender collects a portion of these expenses. So it's a convenience feature. I advise for it. It's fine. It's just like one less headache to deal with, is just making sure these things are paid. You don't have to do it. You can pay these things on your own. Some lenders require it, or some situations require it, that you do use an escrow account. But that's essentially what happens when you purchase a home and use an escrow account. Okay. Next slide. Okay. So if you are in a financial situation such that you have extra money left over at the end of every month, and you have plenty of money growing in investment accounts and strategies, and you're just doing wonderful in life, it might make sense to pay down your mortgage. So you make an extra payment, meaning that if I was paying $2,000 a month and I have extra money, I might pay an extra $500 a month or an extra $1,000, and I've contributed more money to the mortgage, paying it off. What that does is you will shorten the amount of time that you've been in the mortgage. And what I mean by that is, if I have a 30-year fixed and I make extra payments, what happens is you'll probably finish paying off the mortgage in year 25 instead of year 30. That's what happens. By doing that, you've paid less interest to the mortgage company. That's what extra payments do. When you make extra payments, your original payment does not go down, especially with fixed mortgages. Okay. So you still owe the same $2,000 a month, even though you sent in an extra $50,000. Doesn't matter. You still have to pay the $2,000 a month. Okay. Now a prepayment penalty. Banks want their money. Okay. So they see the amount of money that they make off of the loan is through the interest payment, right? So they want those payments to come in. So a lot of times what they'll do is just say, look, you can't get out of this mortgage in 2 years. Well, you can't get out of this mortgage in 3 years. If you do, you can get out, but you have to pay us an extra penalty for getting out early. Not so common in the world anymore, but there was a time where this happened a lot. So you have to be aware. But there's all kinds of mortgages out there. So like, there's all different kinds of advanced mortgages. So you have to be careful. You just got to find out what the terms are. Okay, so time will go on in your mortgage, right? And the world's going to change around you. For instance, interest rates will go up while you're in the same mortgage. Interest rates might go down while you're in the same mortgage. The value of your home will go up typically over time. They could go down. That has happened, right? When the world around you changes, what happens is it might make sense to redo your mortgage, right? So we use the term refinance, which is just meaning I redo it. I start all over again, right? Now, the advantage of that is, what happens if the value of my home has gone up, right? So the house was originally purchased for $500,000. Now it's worth $750,000. That's good. And interest rates have gone down. That's good. So I can make a lower monthly payment moving forward for the same house. That what you would do is refinance. So you're just doing the mortgage all over again. Okay. Yeah, like it says, it's a new mortgage.
All right, we were going to go into that explanation of the 3 different types. You want to do that now?
Oh, yeah. Okay.
The comparison.
So a lot of people wonder, when I go show up to the mortgage conversation with a mortgage professional, they're going to say, well, what do you want? Do you want to buy the house cash? Do you want to have a 15-year mortgage? Or do you want to have a 30-year mortgage? Okay, well, how much interest will you pay on a mortgage if you pay cash for the house? And it's a silly question. The answer is 0. You make no mortgage payments and no interest payments. Therefore, you paid the bank nothing. Okay. So theoretically, you might say, wow, somebody has a lot of money sitting in a bank account and they have the power to go and buy a house cash. Should they? Well, if you don't want to pay any interest, yeah, do it. Okay. All right. So that's a choice you have. Pay no interest. So no profit goes to the bank. But is that the smart thing to do? Right. So what I want you guys to start thinking about in this conversation is wealth. I'm trying to build wealth over time. I'm a wealth manager. So I teach people how to build wealth over long periods of time. So one way in which people think that they build wealth is by paying less in fees and taxes and costs and interest, right? Yes, that makes sense. But when you do that, something else happens. That's the concept here. When I make a decision, what is the ramification in the whole world of finance? So choice A is pay cash, okay? Choice number 2 is I can get something called a 30-year mortgage where the interest rate, let's just say in my example was I believe it was like 6.8%. Okay. So if I pay 6.8%, how much do I pay for my mortgage? Well, $2.9 million. Okay. Now a 15-year mortgage means I pay for 15 years and the interest rate is less and I pay 6.0%. So 6.0 is less than the 30-year mortgage was a 6.8. Got it? Okay. So the interest rate is less with a 15-year mortgage. The interest rate is higher with a 30-year fixed. Okay. Now, what you have to understand is you will pay more interest to a bank in a 30-year mortgage than you would with a 15-year mortgage. The thing is that if you do a 15-year mortgage, you have a higher payment. Well, what if you don't pay the higher payment? What if you pay the lower payment, which is the 30-year, right? Because it takes longer to pay it off, so the payment is less. And I take the difference between the payment of a 15-year and the difference of a 30-year, and I take that difference and I put it into an investment account. Right? I don't care what kind of investment account it is. Stocks, bonds, CDs are paying almost 5% these days, right? And you put it into something like that and let that grow over time. How wealthy are you 30 years later? Well, you're actually wealthier if you do the 30-year fixed because you've saved on, you've grown the investment account and you've saved on taxes along the way because part of your mortgage, the interest that you pay, all right, is deductible against your taxes every year. If you use that savings, you end up with wealthier by using the 30-year fixed because the payment's less, you get to invest the difference. And now the problem with the paying cash is you remove all those dollars from investment. It could have been invested, those dollars, right? So that's the distinction. So oftentimes, even though you pay more interest, the 30-year fixed turns out to be a better decision. Not always, though. You have to do the comparison. Are we still good?
Yep.
Great. So I'm done. So is there questions?
Yeah, let's go ahead and go to a couple of questions. We had a question about the amortization schedule that you had up there. Maybe you want to share that again. Can you talk about, like, say a person had that loan and they were moving in that after 5 years, how much would they have to sell it for in order to make money? So can you talk about selling and
Making
kind
money. Yeah. Okay, that's tricky. Okay, so you could get into the weeds with this in terms of like, what did you actually make, right? And so just think of it like this. If I buy a house for $300,000 and I sell it 5 years later for $350,000, how much money did I make? The answer is $50,000, right? Pretty easy math. That's it. That's your profit. Now, the problem is people go, well, what about the payments I made? And what about the interest payments I made? Yes. So you start subtracting the interest that you paid along the way, and you can start to see what was your true profitability. See, the problem with that though goes into, well, wait a second. If you start analyzing the interest aspect of it, right? See, you might go, well, wait, I paid that much money in interest. So that's sort of like a deduction against my profitability. Yeah, for sure. But if you weren't in the house, where would you have been if you had been in the house? Well, you would have been renting, right? So you have to compare that to what your rental payment would have been. And that's where it gets like a little squirrely if you want to get like, what's the true payment, right? So the true profitability. So people tend to just go, well, I made, I made $50,000 on the transaction, but and I paid this much money in interest, and that's sort of my profitability. So.
Okay, interesting. I got another question here. Can you go over PMI again and when you're typically eligible to have it eliminated?
Okay, so every bank is different. They have their own rules. Generally speaking, let's just say that you put down 10%. Okay. So you should have put down 20, but you put down 10. You put down half of what you should have put down to avoid the PMI. Okay. So think about this. When will the amount I owe versus the value of the home become an 80-20 ratio, right? I mean, that's the reality. Like, when does that happen? Well, how do I get that 80-20 ratio to happen? Two things could happen. Either one, the value of the house goes up or skyrockets, right? Because I could have the same balance of a mortgage, right? But if the house is doubled in price in value, now I'm at that 80-20 ratio, right? So if the value of the home goes up, that might be a way to eliminate it. Okay, but that takes time. Typically, you don't gain 10 or 20% over the course of a year. I mean, it has happened in certain locations, but it takes time for that to happen. The other way in which that the value, that 80-20 ratio will unfold is if you make payments over time, right? The more the principal balance gets reduced. Now, what's nice is typically both happen at the same time. As you're making payments, the balance is going down, and as time goes on, the value is going up. When you get to that 80-20 ratio, you call up the mortgage company, say, hey, I got this 80-20 ratio now, get rid of my PMI for me. And they'll say, sure, we'll either do it for you, right? Or you can refinance out of it, right? So what is a refinance? It's just doing it all over again. And when you do a refinance, you don't have to do it with the same bank. You do it with a different bank, right? So then there's like, it gets all kind of complicated. It's like there's certain rules, like instead of it being 80-20 ratio, it's got to be like 78-22 for them to entertain the idea and remove it automatically. Like it gets like in the weeds as well. But that's typically how you do it is as time goes on, you'll pay it down. And then, but you got to pay for an appraisal, right? Someone has to go out into the property. You have to get approved again, kind of thing, if you do refinance. So there's like, it's complicated, but it can be done. It happens all the time. Oh, you're on mute.
That's okay. Can you talk a little bit about paying extra on principal and how you talked about like paying off a 15-year versus a 30 versus the cash. Does it make sense to pay extra on your principal? Talk a little bit about that.
Yes. Okay. So, most people have a fixed amount of money that's available to them. Okay. So it's not like there's just this overwhelming flow of money coming into everybody's life, right? Most people that I talk to have a budget, right? And the budget says something like, I got a mortgage, I got to eat, I got to pay for these kids, right? And I got to like drive this car around and got to have like health insurance, right? So, typically there's money left over at the end of all that, and that's got to go somewhere, right? And typically it should go to investment strategies that are going to generate wealth for you. When I say investment strategies, I'm not talking just the stock market. I'm talking about anything. You have a choice of what you do with these dollars, right? Checking account, savings account, you can put it into, real estate, you can put it into the stock market, you put it in the bond market, whatever you want to put that money into. So these dollars are valuable to you. All right. Where are the dollars best used? Well, if you're talking to a wealth manager, okay, it's the thing that's going to build wealth for you over time. So what are the tools that build wealth for you over time? is, like typical investment strategies, right? So I tell people, hey, build up your investment strategies, get these assets that you have to really grow over time. Okay. Now, the assets you put your money into should do something as well, right? They should provide you with money, right? Cash flow, dividends, right? Rental income payments. If you're buying real estate, they're giving you rental income. Take those dollars and then perhaps maybe pay down your mortgage faster. But you have to have those things first. You have to build up assets first before you worry about paying down your mortgage. Because here's what you would do. If people in our society, and I know people in society have mortgages, they got student loans, they're huge. And you have credit cards, right? If you spend your whole life paying off your debts as fast as humanly possible, you could, I'm not saying you will, end up with no money when you're 50, 60 years old because you just paid off. I applaud you for having all your debts paid off, but you got no money now, right? So everybody has to speak to a professional, look at the whole giant financial picture and decide where are these dollars best used. If you end up in a financial situation where you are crushing it, you're dominating, then let's entertain the idea of paying down that mortgage faster. That's how I would approach that.
All right. Yep. We had a good comment here about refinancing when your rate is in the 2s and now interest rates in the 6s, just how it's fluctuated. And yeah, refinancing might not be.
No, I mean, like those people who got mortgages in the 2s and the 3s, that was like a once in a lifetime opportunity. It may never come back again. It may, I don't know, but hold on to that mortgage and love it because it's just, it's not common, right? If you average interest rates over time, over many 30, 40 years, you'll see it's not 2, it's much higher. So
yeah,
congratulations if you got that.
Well,
but for someone like you who has an interest rate of 2%, but you want to be strategic with your mortgage, home equity lines of credit are separate loans that you get against the same property. And if you want to use that to your advantage, you can use them. Home equity lines of credit are a powerful tool. Oh, one last thing I didn't tell everybody is there's another tool out there, another mortgage called a reverse mortgage. It is something that you will utilize in the 70s and 80s. A very powerful tool. We could talk about that on another call. It's a little bit more complicated, but another mortgage, very valuable if used correctly.
Well, we had another question here. When shopping around, does it make sense to go with a mortgage broker who will shop for you, or individual bank or mortgage banks? Talk to us about the professional that can best help you in getting a mortgage.
Like I've seen it all, heard it all. So meaning I've been in situations where the local bank has the lowest interest rate. They have simple terms for getting the thing approved and they're good to go, right? Then you have situations where maybe your situation is a little bit more complicated and the local bank's not going to give you the mortgage. I mean, it's just that happens. They just have a different set of guidelines. And so then you got to go to a broker who can find a company that's going to provide you with, just getting you approved, right? So the approval process is nuts. It's not fun. It's crazy. And so, yeah, so the broker might be the best person for that. Yeah, that's all. I mean, it's really anyone can provide you with it. It's a big business. There's plenty out there. We're actually, you're probably bombarded with marketing in the mortgage world all day long. But you do your due diligence on shopping, and yeah.
All right. Well, that's about all the time we have for questions today. We want to thank everyone for participating. I want to thank JR for being here and for the organizations that have made this webinar possible today. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. We're getting a thank you from our comments here, and really appreciate your input here, folks on the call. Again, visit us at Advice Chaser if you are interested in finding an advisor, and we hope to see you at another webinar soon. Goodbye, everyone.
Bye.